Welcome back to Iron Financial, everyone. Today, we're putting on our hard hats and conducting a complete, ground-up structural inspection of an absolute retail behemoth. We are talking about Costco Wholesale Corporation and specifically their Q3 2026 earnings report. Look, in a macroeconomic environment right now where the broader retail sector is showing severe signs of metal fatigue, we're seeing major chains slashing their guidance left and right, warning of massive consumer pullbacks. Costco remains this fascinating, almost bulletproof anomaly. If you want to forge a stronger portfolio and really cut through the market weakness we're seeing out there, make sure you hit that subscribe button. Let's dive right into this explainer. I'm your lead analyst, and today I'll be drilling deep into the revenue, the debt, the margins, and the fundamental bedrock of this company.
And hey, I'm the market skeptic. Look, Costco is obviously a household name. We all know it. But right now, it is trading at well over $1,000 a share. So the stakes here are absolutely massive for investors. My job today is to push through all the retail hype and find out if this is actually a structurally sound investment for your hard-earned capital, or if the market has simply priced this thing for absolute perfection in a deeply imperfect world.
So here's the core question we really need to answer today. Is Costco's Q3 performance a solid, load-bearing foundation for your portfolio, or is it just an overpriced trap waiting to cave in on you? We're looking at a stock that is trading at a towering 52.2 times forward earnings multiple. To put that into perspective for you, a traditional, healthy retailer usually trades somewhere between, 15 to maybe 25 times earnings. In the construction of any solid portfolio, paying a premium that heavy means there's absolutely zero room for structural error. If a single pillar wobbles, like if growth misses by even a fraction of a percent, you risk severe multiple compression. The whole valuation could just crack wide open.
That is exactly why we need to inspect the blueprint today. A 52x multiple is steep, right? No one is denying that. But as you'll see, Costco's business model is engineered completely differently than traditional retail. They don't rely on massive merchandise margins to survive. They rely on this ironclad loyalty loop. So let's look at exactly how we're going to break this down.
Here is the iron blueprint for today's explainer. 1. Forging the foundation. 2. The heavy lifting. 3. The load-bearing memberships. 4. Digital reinforcements. 5. Cracks in the armor. And finally, 6. The iron verdict.
Let's get right into Section 1, Forging the Foundation, the Q3 macro environment. Okay, before we evaluate the internal metrics of the business, we have to recognize the external pressure this structure was actively subjected to. During the 12 weeks ending May 10, 2026, the macro environment was incredibly heavy. There was massive market volatility, serious tensions in the Middle East that were actively impacting global product supply and causing huge, unpredictable swings in gas prices. And on top of that, shifting consumer spending habits. People were tightening their belts. But despite all of that weight, Costco just kept pouring concrete. Net sales hit a staggering $69.15 billion. That's not a typo. That is an 11.6% jump from $61.96 billion in the exact same quarter last year. Net income surged to $2.19 billion, and diluted earnings per share forged ahead by 15.2% to hit $4.93. Okay, I'll admit, double-digit top and bottom line growth under those specific macro conditions is undeniable strength. Earning nearly $5 a share in a single quarter while the rest of the retail sector is on earnings calls desperately trying to explain away consumer pullback, it's deeply impressive. But, and this is a big but, top-line revenue can be dangerously misleading in an inflationary environment. Which brings us to Section 2, the heavy lifting, breaking down comparable sales. Yeah, this is exactly where I need to demand proof. I need to know if the physical warehouses are doing the actual heavy lifting or if rampant inflation is just masking structural weakness. Think about it. If you're charging more for the exact same pallets of goods, your headline revenue obviously goes up, but your core business isn't actually getting any stronger. I want to really stress test these sales figures right now.
Fair enough. We strip away the headline noise right here. Total company comparable sales grew by an impressive 9.8%. But to answer your inflation question directly, we have to look at the adjusted, clean numbers. When you actually strip out the extreme volatility of gasoline prices at the pump and foreign exchange rates, adjusted comparable sales still sit at a rock-solid 6.6%. That clean comp is formidable. It proves true strength because it shows the core merchandising engine is running hot across their 931 global warehouses, completely independent of those inflationary pricing masks.
Fine, the core engine is working. I see that. but I'm looking at that 2.4% comparable traffic growth. That is positive, sure. But how does that balance out with what people are actually spending once they walk through those big concrete doors?
The crucial point here is exactly how those two metrics interact with each other. Worldwide shopping frequency, meaning actual foot traffic into the stores, was up 2.4%. But the average transaction size, the actual ticket at the register, that jumped a massive 7.3%.
And see, that is the pressure point. Are members yielding to economic pressure, or are they genuinely buying more? We know people are coming in slightly more often, but a 7.3% jump in ticket size is huge. Now, when you take out gas and effects, the core transaction size was still up 4.2%. That tells me people are loading up those oversized cards heavier than before. They aren't just going in to buy bulk paper towels, they are likely buying higher ticket items like appliances, fresh foods, and electronics. But come on, you absolutely cannot ignore the impact of gas. How much of that total foot traffic is just people hunting for cheap fuel?
A highly significant amount, actually. And Costco leverages that dynamic brilliantly. They set all-time company records for gasoline volumes in each and every 4-week period of this quarter. CEO Ron Vatris explicitly noted on the call that the final 5 weeks were the highest in company history. High pump prices essentially act as a massive traffic driver for them.
Right. It is a classic loss leader strategy, or at the very least, an extremely low margin lure. You pull these members into your massive parking lot with cheap gas during a volatile, expensive energy market, and once they are physically sitting on the property, the friction to just walk inside the warehouse is completely eliminated. Costco's warehouse layout is highly deliberate. You walk past the high-margin electronics and the seasonal goods just to get to the rotisserie chicken and the milk all the way in the back. The gas pump gets them on the lot, the layout gets them to drop $200. It's structural genius, I'll give you that, but only as long as those members actually keep renewing their cards.
And that transitions us perfectly to Section 3, the load-bearing memberships, the core engine.
Listen, Costco operates on razor-thin product margins for a reason, because the subscription model guarantees reoccurring revenue. This is the structural steel of the entire operation. Membership fee income for Q3 hit an incredible $1.37 billion. That is up 10.7% year over year. That is pure, unadulterated, high-margin cash flow driven by a total of 82.9 million paid members globally.
It's literally free money before a single item is even sold off a pallet. And notice that a significant chunk of that 10.7% growth comes directly from the recent US and Canada fee increase. They raised the rent on their members by $5 on the standard tier and $10 on the executive tier, and the tenants flat out didn't leave. Worldwide membership renewal is holding at an incredibly sticky 89.7%. But as an analyst, I have to ask, is the growth starting to plateau here? Are they simply running out of demographics to actually sell new memberships to?
I'll answer that by dropping the hammer with this single incredible statistic. 75%. Paid executive memberships, meaning the highest tier that literally costs double the standard fee, reached 41.2 million, which is up 9.6%. And those executive members now account for a staggering 75.0% of total company sales.
Wow, okay. That radically changes the structural dynamic. They aren't just relying on adding brand new members to keep growing. They are actively converting their existing members into a heavier, much more lucrative tier. And the mechanics behind that are brilliant. The executive tier offers a 2% annual reward on purchases. That creates a psychological, behavioral loop. The member feels compelled to spend more of their money exclusively at Costco to earn back the upfront cost of that upgraded fee. When 3/4 of your massive sales volume comes from your most loyal, heavily incentivized demographic, man, your revenue stream becomes incredibly predictable and highly resistant to macroeconomic shocks.
Exactly. And to prove the sheer durability of this customer base, the US and Canada renewal rate currently sits at an unbelievable 92.2%. That's actually up 10 basis points sequentially.
A 92.2% retention rate in North America is virtually indestructible. It completely proves that the core value proposition, the ongoing daily savings on gas, bulk food, and apparel, vastly outweighs the upfront cost of the membership card. Even with inflation pinching consumer wallets everywhere else, members clearly view Costco not as a discretionary expense to be cut when times get tough, but as a necessary utility to actually survive a tough economy.
Let's look at Section 4, digital reinforcements, e-commerce and AI.
Historically, Costco has been a stubborn brick-and-mortar purist. They wanted you in the store. But in this quarter, we're seeing them actively reinforce their massive physical footprint with heavy-duty digital tools. We saw a 21.5% surge in digitally enabled comparable sales. Even when you adjust that for foreign exchange, it's still a 20.8% jump. An e-commerce site and app traffic spiked by a massive 37%.
Finally, I mean, for years, analysts have rightfully criticized Costco's digital storefront as being stuck in like 2010. A 37% spike in traffic shows they are finally modernizing. The top sales growth categories online were pharmacy, gold and jewelry, and home furnishings. That makes perfect structural sense. These are bulky items or high-trust commodities that people don't necessarily want to haul through a warehouse themselves. But what are the actual mechanics driving this 21% sales surge? Is it just a slightly better app interface, or are they structurally upgrading their underlying logistics?
Oh, it is a complete logistical and technological upgrade. First off, they've partnered with third parties like Uber to get average same-day delivery times in the US down to under 45 minutes with a highly rated 4.8 out of 5 member satisfaction score. Second, they are actively rolling out a shopping cart pre-scan tool internationally. This allows members to just scan items as they shop, virtually eliminating checkout line friction. And third, AI integration. Personalized product recommendation carousels delivered conversion rates 3 times better than their standard baseline, contributing nearly $5 billion to e-commerce sales.
Market skeptic. Wait, $5 billion driven specifically by AI recommendations? Okay, that's not just corporate buzzword compliance for an earnings call. That is serious load-bearing revenue. If their algorithm can figure out how to replicate the physical treasure hunt experience digitally, placing unexpected high-margin items next to planned purchases on your screen, just like they do in the physical aisles, that opens up a massive new growth corridor that they barely even tapped into yet.
All right, Section 5. Cracks in the armor. Assessing the risks.
Remember, this is Iron Financial, and we don't just stand back and admire the architecture. We aggressively stress test it. Every single structure out there has hidden vulnerabilities, bleeding margins, or overhyped metrics. It's time to find out what could bring this towering stock back down to earth. Let's point out the most glaring, flushing red light on the entire dashboard: valuation. At 52.2 times forward earnings, this stock is priced for absolute, flawless perfection. As I said earlier, to justify a 52x multiple, Costco cannot afford a single miss. If membership growth stalls even slightly, or if a new competitor heavily disrupts their model, a multiple this heavy will compress violently. If growth drops from, say, 10% to 4%, the market won't just lower the stock slightly. They'll slash the multiple down to 30x, and the share price will absolutely plummet. You are paying a massive premium for safety right now, which paradoxically creates immense risk for your portfolio.
I hear you. And part of that rigorous stress test means looking very closely at margin compression. In Q3, total gross margin was 11.04%, which is actually down 21 basis points year over year. If we look at core-on-core sales, the margin decreased by 9 basis points. CFO Gary Millerchip noted on the call that this was directly driven by lower margins in fresh foods like produce and meats, as well as sundries like paper goods and cleaning supplies.
Exactly. That's exactly what I'm talking about when I mentioned bleeding capital. A 21 basis point drop in gross margin might sound small through a layman, but on $69 billion in quarterly sales, that is a massive amount of operating capital bleeding out of the foundation. If inflation stays sticky across the supply chain, and they refuse to pass those rising costs onto the consumer for fear of losing that 92% loyalty, those margins will just keep compressing, quarter after quarter.
But I'm going to counter your margin fears directly with this core operational philosophy from CEO Ron Vakras. He said, "We are the first to come down and the last to go up." See, these aren't accidental cracks in the armor. This is intentional, strategic investment. They took deliberate price cuts on Kirkland's signature items. Crispy wings dropped from $16.99 to $14.99. Kirkland golf balls dropped from $32.99 to $29.99. They are willingly sacrificing a few basis points of margin on specific items to forge even deeper member loyalty.
Market skeptic. Oh, I understand the strategy perfectly. Give up a little margin on milk chocolate almonds and king-size sheets to ensure the member keeps renewing at $120 a year. It's a calculated long-term play. But Wall Street isn't always patient, my friend. If those margins stay suppressed for too many quarters, that 52x multiple is going to get very, very heavy for institutional investors to hold.
And let's not ignore the remaining structural risks here. One, they're waiting on Section 301 tariff refunds from U.S. Customs. That involves serious legal red tape over the next 2 to 3 months, which means significant capital is tied up and delayed from being returned to the balance sheet. Two, Gary Millerchip admitted that year-over-year membership growth is normalizing back down to about 4% or 5%. The massive artificial bump from COVID and the hype of opening untouched new markets is largely over. We are returning to a standard baseline growth. 3, gas price volatility makes a huge chunk of their daily foot traffic entirely unpredictable. And 4, their actual physical expansion pace isn't exactly explosive.
Those are entirely fair points. The expansion pace is very steady, but it's true. They did slightly adjust their fiscal year outlook to 26 net new openings, pushing 2 locations out into fiscal 2027 due to construction timelines. It's a calculated, deliberate, brick-by-brick build-out. It guarantees stability, but it absolutely does not offer the explosive, rapid-fire growth that growth investors usually demand at a 52x multiple.
All right, that brings us to our final section. Section 6, the iron verdict. Opportunity or trap? Let's weigh the ledger here and evaluate the flawless operational execution of this company against its towering premium valuation. On the bullish foundation side, we have an unbreakable 92.2% North American retention rate, double-digit 21.5% digital e-commerce growth, and a massive surge in top-tier executive members who are now generating 75% of all sales.
And heavily weighing down the bearish crack side, we have the immense, undeniable weight of a 52x PE ratio, intentional but very real operating margin pressure, and a normalizing 4 to 5% baseline growth rate for new signups. The structural foundation here is made of pure titanium, but you are paying an absolute top-tier premium to own a piece of it today.
Here is the final iron verdict for you all. Costco is an undeniably expensive stock, but the underlying financial foundation is quite simply one of the most durable, load-bearing structures in the entirety of modern retail. Look at the cash. They are generating a phenomenal $11.13 billion in operating cash flow over just the first 36 weeks of the year. That massive cash generation easily secures their special dividends and fully funds their methodical warehouse expansion without taking on dangerous debt. The membership fee is practically a guaranteed annuity in an unpredictable world. If you are looking for pure structural integrity to anchor your portfolio in a volatile market, this blueprint is as strong as it gets. It's a strong company, no doubt about it, but in the reality of investing, price matters just as much as quality. So I leave you with this final provocative thought. At 52 times forward earnings, knowing the margin pressures and the normalizing baseline growth, do you have the capital to forge ahead and invest in this premium foundation right now? Or are you going to keep your powder dry and wait for the broader market to crack, hoping for a cheaper, safer entry point? Let us know in the comments below. Thanks for joining us for this structural inspection. And as always, keep your portfolios forged in iron.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.